Before we dive in, it is critical to understand that the information in this video is for educational and informational purposes only. I am not a licensed financial advisor, mortgage broker, or attorney, and this presentation is not a substitute for professional financial or legal advice. The mortgage industry is complex and subject to change, and your individual financial situation is unique. Always consult with a qualified professional before making any major financial decisions. Your mortgage lender is hoping you don't watch this video. I'm not saying that to be dramatic. I'm saying it because the entire mortgage industry is built on something called information asymmetry. That's a fancy term for a simple and frankly dangerous reality. They know everything, and the average homebuyer knows next to nothing. They close hundreds of loans a year. You might do this 2 or 3 times in your entire life. This imbalance of knowledge is where mistakes are made. It's where tens, even hundreds of thousands of dollars are lost over the life of a loan. Picture this for a second. You've done it. You found the house. It's the one. It has the big backyard for the dog, the school district you wanted, the kitchen that looks like it came straight out of your saved posts. The feeling is electric. You're so excited you can barely think straight. Your real estate agent says, "Hey, I've got a great lender, you should call them." So you do. The person on the phone is friendly, they're congratulatory, they say all the right things. They run your numbers and come back with the magic words. You're approved. The relief is overwhelming. They send you a mountain of digital paperwork. You click sign on 50 different boxes, and you don't read a single one. You're too busy picking out paint colors and planning the housewarming party. You just want the keys. Then, 3 years later, you're sitting at your kitchen table, that dream kitchen table, and you're looking at your mortgage statement, really looking at it for the first time. And a cold feeling starts to creep into your stomach. You notice a fee you don't recognize. You see that your monthly payment went up and you don't know why. You talk to your new neighbor, who bought their house a month after you did, and you find out their interest rate is a half a point lower than yours. You do the math. That half a point, those little fees, that unexpected payment jump, it's costing you $400 a month. That's nearly $5,000 a year. Over 30 years, that's $150,000. Enough to have sent your kid to college. Enough to have built a nest egg for retirement. And in that moment, your dream home starts to feel a little bit like a financial prison. This scenario isn't a scare tactic. It happens every single day in America. It happens because homebuyers are so focused on the house that they forget they are also buying a financial product. And that product, the mortgage, is actually the most expensive thing you will ever buy. More expensive than the house itself when you factor in interest. The good news is you can prevent this. You can completely flip that power dynamic. You can walk into a conversation with a lender not with fear or uncertainty, but with the confidence of an insider. This video is your playbook, your cheat sheet. I am going to arm you with the 10 essential, non-negotiable questions you absolutely must ask any mortgage lender before you even think about signing on the dotted line. These aren't just surface-level questions. These are the keys that unlock the truth behind the numbers. They will expose hidden fees, clarify confusing terms, and instantly tell you whether you're dealing with a true professional who has your best interests at heart, or a salesperson just trying to hit their monthly quota. Getting this right isn't just about saving money. It's about buying your home with clarity, control, and complete peace of mind. So let's get into it. The very first question you need to ask is the one that seems the most obvious, but its second part is what truly matters. You must ask, what is the interest rate? And what is the annual percentage rate, or APR? If you only ask for the interest rate, you've already lost half the battle. Lenders know that homebuyers are laser-focused on that one number. The interest rate. Is it 6.5%? Is it 7%? They will use a low, attractive interest rate as bait to get you in the door. But the interest rate is not the true cost of your loan. Think of it like this. The interest rate is the sticker price of a hamburger patty. But you're not just buying the patty, are you? You're buying the whole meal. The bun, the cheese, the lettuce, the fries, the soda. The APR is the price of the entire meal. It's the total, all-in cost. The annual percentage rate takes the interest rate and then bakes in most of the other costs of borrowing the money. We're talking about things like origination fees, which is the fee the lender charges for creating the loan. We're talking about discount points, which is money you pay up front to buy a lower interest rate. It includes many of your closing costs, private mortgage insurance, and other lender-specific charges. The APR expresses all of these combined costs as a single, annualized percentage. This is why it is almost always higher than the advertised interest rate. And this is why it is the single most powerful number for comparing loan offers from different lenders. Let me give you a real-world example of how this plays out. You call lender A, and they offer you a 30-year fixed loan with a 6.75% interest rate. Sounds pretty good. Then you call lender B, and they offer you the same loan at a 6.875% interest rate. Naturally, you think lender A is the better deal, right? Lower rate, lower payment. But then you ask our magic question. You ask for the APR. Lender A comes back and says their APR is 7.25%. Lender B comes back and says their APR is 7.05%. Suddenly, the entire picture has changed. Lender B, the one with the higher interest rate, is actually the cheaper loan over the long run. Why? Because lender A was burying thousands of dollars in origination fees and other closing costs into their loan. They dangled a shiny low rate in front of you, knowing that most people would never ask the follow-up question. By asking for the APR, you instantly see through the marketing gimmick and get to the real truth of the cost. You are now comparing apples to apples, or in our analogy, the total price of one meal to the total price of another. When you ask this question, pay very close attention to how the lender responds. A great loan officer will be happy you asked. They'll say, "That's an excellent question," and they will clearly and patiently explain the difference and what fees are included in their APR calculation. They'll be transparent. A lender who is trying to pull a fast one might get flustered. They might try to downplay the APR, saying, "Oh, don't worry about that number. It's confusing. Let's just focus on the great rate I'm getting you." That is a massive red flag. That is your signal to thank them for their time and hang up the phone. Transparency is non-negotiable when you are talking about a $500,000, 30-year commitment. So, your first piece of homework is simple. Never, ever entertain a conversation about a mortgage without getting both the interest rate and the APR. Write them down side by side for every single lender you speak with. This single question forms the foundation of a smart comparison, but it's only the beginning. Because even within the APR, there are specific fees and charges that can be negotiated, reduced, or even eliminated entirely if you know what to look for. And that brings us to the next layer of this onion, where we start to dismantle the loan itself piece by piece. So the second essential question you absolutely must ask your lender is this. Can you provide a line-by-line itemized breakdown of all closing costs, and tell me which of these fees are set by you, the lender, and which are third-party fees I can shop for? This question is your financial scalpel. Because when a lender hands you a loan estimate, they are legally required to list out these costs. But most people just glance at the big, scary number at the bottom, the total closing costs, and their eyes glaze over. They feel powerless. But that number isn't a single solid block of granite. It's a pile of smaller rocks, and some of those rocks can be moved, shrunk, or thrown out entirely. Let's imagine a couple, we'll call them David and Jessica. They're buying their first home, a charming little place in a suburb they love. They're excited, they're nervous, and they're trusting. Their lender, a friendly guy named Bob, sends them a loan estimate. The interest rate looks good, the monthly payment seems manageable, and the closing costs are, well, they're high, but Bob assures them, that's just standard. David and Jessica nod, sign, and move on, focused on paint colors and moving trucks. Fast forward to closing day. They sit down at the table, and the final document, the closing disclosure, has a number that's $2,000 higher than they expected. Panic sets in. They ask Bob what happened. He pulls out the paperwork and points to a bunch of line items. A processing fee, an underwriting fee, a courier fee, and a higher than expected charge for title services. He says, "Oh, those are just standard administrative fees and third-party costs that fluctuated a bit." David and Jessica feel a pit in their stomach. It's too late to back out. They're at the finish line. So they sign, their joy tainted with the bitter taste of being blindsided. Their savings account now $2,000 lighter than it should be. This happens every single day. And it's completely avoidable if you ask the right question up front. When you ask for that itemized breakdown, you're forcing the lender to separate the costs into three distinct categories. First, you have the lender fees. These are the charges your specific mortgage company is charging you for the service of creating your loan. This is pure profit for them. Think of things like the application fee, the processing fee, the underwriting fee, and the origination fee. These are often the most negotiable. An underwriting fee, for example, is the cost for the lender's underwriter to review your file and approve the loan. But often, this cost is already baked into the lender's overall business model. The separate line item is just extra padding. You can say, I've seen other offers that don't include a separate underwriting fee. Is this something you can waive? Sometimes they will, sometimes they won't. But if you don't ask, the answer is always no. The same goes for processing or application fees. Asking to have them waived, especially if you have a strong application, can instantly save you hundreds of dollars. The second category is third-party fees. These are costs for services performed by other companies that the lender requires to close the loan. This includes the appraisal fee, the credit report fee, flood certification, and the big one, title insurance. Now the lender will give you a list of their preferred or in-house providers for these services. But here is the secret. For many of these, you have the legal right to shop around. The lender's preferred title company might charge $2,000. But you might find a highly rated independent title company a few miles away that will do the exact same work for $1,500. That's $500 back in your pocket for making a few phone calls. Your lender isn't going to volunteer this information. You have to ask, for which of these third-party services am I allowed to choose my own provider? The third category is the truly non-negotiable stuff. These are things like government recording charges, which is the fee your local county charges to officially record the sale, and state or local transfer taxes. These are set by law. You can't negotiate with the county clerk. But by isolating these costs, you know exactly what bucket of money is fixed, and you can focus all of your negotiating power on the first two categories where you actually have leverage. So by asking for the breakdown, you transform from a passive victim of standard fees into an active, informed consumer who is dissecting the deal. Now, once you've got the fees minimized, we need to talk about the interest rate itself. This brings us to the third, and perhaps most misunderstood, question of all. Can you explain discount points to me and show me a break-even analysis for buying them? Discount points are one of the most powerful tools a lender has, both to help you and to confuse you. Simply put, one discount point costs 1% of your total loan amount. So on a $400,000 loan, 1 point would cost you $4,000 paid upfront at closing. In exchange for this upfront payment, the lender gives you a permanent reduction in your interest rate for the entire life of the loan. It sounds simple, right? Pay more now, pay less later. But the devil is in the details, and the detail that matters most is the break-even point. Let's go back to David and Jessica. Imagine an alternate reality where they're a bit more savvy. Their lender, Bob, offers them a loan at a 7% interest rate. But he says, hey, for just 1 point for $1,000, I can get you a rate of 6.75%. A lower rate for the next 30 years sounds amazing. But the savvy Jessica pulls out her calculator. Their monthly principal and interest payment at 7% on their $400,000 loan is $2,661. At 6.75%, the payment drops to $2,593. That's a monthly savings of $68. Now for the crucial step. They paid $4,000 up front to get this $68 monthly saving. So, how long will it take for those monthly savings to add up and pay back the initial $4,000? You divide the cost of the point $4,000 by the monthly savings, $68. The answer is 58.8 months. That's almost 5 years. The break-even point is 5 years. This is the moment of truth. Jessica asks David, honey, are we absolutely certain we're going to be in this house with this same mortgage for more than 5 years? David thinks about his job. He's up for a promotion, but the new role might require relocating to another state in 3 or 4 years. Suddenly, paying for discount points looks like a terrible bet. If they move in year 3, they will have spent $4,000 to save just over $2,400. They would have literally thrown away $1,600. You see, lenders love to sell points because it boosts their commission and makes the loan look more attractive with a lower headline interest rate. They will tell you all about the benefit, the lower rate, but they rarely volunteer the break-even calculation. You have to demand it. Don't just ask, should I buy points? That's a yes or no question that invites a sales pitch. Ask, can you show me the break-even analysis? This forces them to do the math with you. Ask them to show you options. What does the loan look like with 0 points? With 1 point? With 2 points? What is the exact break-even in months for each scenario? The decision to buy points is deeply personal. If you are 100% certain you're in your forever home, and you plan to stay for decades, buying down the rate can save you an enormous amount of money over the long haul. But if there's any uncertainty, if you might move for a job, if you might need a bigger house as your family grows, or if you think interest rates might fall in a few years and you'll want to refinance, Then paying thousands of dollars upfront for a small monthly saving is like prepaying for a 10-year gym membership when you know you might be moving next year. It's a losing proposition. By dissecting the closing costs and demanding a break-even analysis on points, you've taken control of the two biggest levers that determine the true cost of your mortgage. You are no longer just accepting the first offer. You are architecting the best possible deal for your specific financial situation. But even with the perfect rate and the lowest fees, there's a ticking time bomb hidden in the process that can blow up your entire deal just days before closing. It's a concept that 90% of buyers think they understand, but their misunderstanding can cost them everything. And that has to do with your rate lock. So what exactly is a rate lock? Think of it like this. You're at the grocery store, and you see that organic, free-range, artisanal chicken you love is on sale for $10 a pound. You know that next week it could be $15. A rate lock is like telling the butcher, I want to buy this chicken, but I need to finish the rest of my shopping. Can you hold this price for me for the next 45 minutes while I get my milk and eggs? The butcher, who is your lender in this analogy, says, sure thing. You've now locked in the price. In the mortgage world, interest rates are the price of money, and they change every single day, sometimes multiple times a day, based on what the financial markets are doing. A rate lock is a guarantee from your lender that they will give you a specific interest rate for a specific period of time, typically 30, 45, or 60 days. It's your shield against the chaos of the market. If rates suddenly shoot through the roof a week before you close, it doesn't matter. You're protected. You have your $10 a pound chicken. But here's where the bomb starts ticking. That lock has an expiration date. And if you go past that date without closing on your home, your lock disappears. Poof! You are now completely exposed to whatever the current market rates are. Let me paint you a picture. Let's talk about a couple, Michael and Jessica. They're buying their first home. They're excited, they're nervous. They find a great lender who quotes them a fantastic rate of 6.5%. They're thrilled. Their monthly payment is right where they need it to be. The lender says, we can close this in 30 days, no problem. We'll do a 30-day rate lock. Michael and Jessica agree. Why pay for a longer one if they don't need it? The clock starts ticking. Day 15. The home inspection reveals a minor plumbing issue. The seller agrees to fix it, but it takes a few days to get a plumber out. That's a 3-day delay. Day 22. The appraisal comes in, but it's slightly lower than the purchase price. Now they have to renegotiate with the seller. That's another 5 days of back and forth. Day 29. Everyone has finally agreed, the paperwork has been updated, and it's sent back to the underwriting department for the final sign-off. Day 31. The underwriter is backed up. The 30-day rate lock has expired. The lender calls Michael. The good news? They're cleared to close. The bad news? Their 6.5% rate is gone. In the last 3 weeks, the market has shifted. The best rate they can offer them now is 7.1%. It doesn't sound like much, does it? A little over 0.5%. But on their $450,000 loan, that 0.5% just increased their monthly mortgage payment by over $250. $250 every single month for the next 30 years. That's an extra $90,000 in interest over the life of the loan. Suddenly their budget is blown. The dream home is now a financial nightmare. They're forced to either back out of the deal, losing their inspection and appraisal money and starting from scratch, or swallow a massive extra cost they hadn't planned for. This happens every single day, and it's completely avoidable by asking the right question up front. So the third essential question you must ask your lender is, what are my rate lock options, what are the associated costs, and what is your policy on extensions and float downs? Let's break that down because it's actually 3 questions in one. First, what are my rate lock options? Don't just accept the standard 30-day lock. Ask to see the options for 45, 60, and even 90 days, especially if you're buying new construction, which is notorious for delays. A longer lock period is your insurance policy, and like any insurance, it has a cost. Which brings us to the second part. What are the associated costs? A longer lock isn't free. The lender is taking on more risk by guaranteeing you a rate for a longer period. They typically charge for this in one of 2 ways. They might offer you a slightly higher interest rate for the longer lock. So, a 30-day lock might be 6.5%, but a 60-day lock might be 6.625%. Or they might charge you an upfront fee, often in the form of points. 1 point is equal to 1% of your loan amount. So, a lender might say a 60-day lock will cost you 1/4 of a point. On a $400,000 loan, that's a $1,000 fee paid at closing. Now you might be thinking, I don't want to pay extra. But look at it this way. Would you rather pay $1,000 upfront to guarantee your rate for 60 days? Or risk a market swing that could cost you $90,000 over the long haul, like it did for Michael and Jessica? The answer is obvious. You need to have an honest conversation with your lender about the realistic timeline for your specific loan. If there's any chance of a delay, and let's be honest, in real estate, there's always a chance of a delay, paying a little extra for a longer lock is one of the smartest financial decisions you can make. Now for the third and most advanced part of the question. What is your policy on extensions and float downs? An extension is exactly what it sounds like. If you're on day 29 of a 30-day lock, and you know you need a few more days, what will it cost to extend the lock? Some lenders charge a hefty flat fee. Others charge a per-day fee. Some won't let you extend at all and you're just out of luck. You need to know this policy before you lock, not when you're in a panic on day 29. But the float down is the secret weapon that most buyers don't even know exists. Let's say you lock in your rate at 7% for 60 days. You made the smart move, you bought the insurance. But 3 weeks later, the market does something unexpected and rates drop significantly. The new rate is 6.5%. Are you stuck with your 7% rate? It feels a bit unfair, right? You protected yourself from rates going up, but now you're being punished because they went down. This is where a float down provision comes in. It's a one-time option during your lock period to adjust your rate down to the new, lower market rate. It's the best of both worlds. You're protected if rates go up, and you can benefit if they go down. Now this isn't a standard feature. Many lenders don't offer it. Those who do often charge a fee for the privilege, and they usually have rules like the rate has to drop by at least 0.25% for you to be able to use it. But you will never know if you don't ask. Asking, do you offer a float down option and what are the terms, can literally save you tens of thousands of dollars. It separates the average homebuyer from the savvy one. So when you're comparing lenders, don't just compare the interest rate they quote you. That number is meaningless without knowing the context of the rate lock. A lender quoting an unbelievably low rate might be attaching it to an impossibly short 15-day lock, knowing full well you'll have to pay expensive extension fees later. It's a classic bait and switch. By asking about the options, the cost, the extension policy, and the float-down provision, you take back control. You're no longer a victim of the market or a lender's aggressive timeline. You're an informed buyer making a strategic decision, ensuring your single biggest investment against a ticking time bomb. You've now locked your rate, you've chosen the right lock period, and you feel safe. But then the lender hands you your official loan estimate document, and your heart sinks for a second. The interest rate you talked about is there, 6.75%. But right next to it is another, higher percentage, 6.95% APR. What on earth is that? Which one are you actually paying? One of them represents the simple interest on your loan, and the other represents the true total cost of borrowing the money. One is a marketing number, the other is the reality. And not understanding the profound difference between them is how millions of people end up paying tens of thousands of dollars more than they expected over the life of their loan. And that brings us to the fourth and arguably most misunderstood question of them all. And that question is, what is the true difference between the interest rate and the APR? And which one is the real number I should be focused on? If you get this one wrong, it can cost you a fortune. Because the mortgage industry has for decades relied on a fundamental piece of human psychology. We are drawn to the simplest, shiniest number. Imagine you're buying a new car. You see two identical models at two different dealerships. The first dealership has a giant banner out front. Sale, only $30,000. The second dealership has a smaller sign, $31,000. Naturally, you walk into the first dealership, feeling like you've already found the better deal. But then as you're about to sign the papers, you see the final price. They've added a destination fee, a dealer prep fee, a documentation fee, and a special paint protection package you never asked for. Suddenly, your $30,000 car costs $34,500 out the door. You storm out, go to the second dealership, and ask for their final price on the $31,000 car. The salesperson says, "That's it, $31,000. Our price includes all the standard fees." Which car was actually cheaper? In this story, the interest rate is the giant sale banner. It's the sticker price. It's the number lenders advertise in bold font because it's simple, attractive, and easy to compare. Your interest rate is purely the percentage of the loan amount you pay to the bank each year for the privilege of borrowing their money. It's the cost of the money itself and nothing more. It's clean, it's simple, and it's dangerously incomplete. The APR, or annual percentage rate, is the out-the-door price. It's the behind-the-scenes number that tells the much truer, more complete story of what you're actually paying. The APR starts with the interest rate, but then it adds in many of the other costs and fees associated with getting the loan, things like origination fees, which is what the lender charges for creating the loan, discount points, which are fees you pay up front to get a lower interest rate, and some but not all closing costs. The APR then takes all those upfront costs, spreads them out arithmetically over the entire 30-year term of the loan, and expresses that total cost as a single unified percentage. It's the government's attempt, through the Truth in Lending Act, to force lenders to give you one number that allows for a true apples-to-apples comparison between different loan offers. Let's put this into a real-world scenario, because this is where the magic happens. Let's say you're buying a home and need a $400,000 loan. You get two offers. Lender A comes in with a beautiful offer, an interest rate of 6.5%. Wow, it's the lowest rate you've seen all week. You're ready to sign. But when you look at the loan estimate, you see they're charging you $10,000 in fees, a 1% origination fee, some discount points you didn't quite understand, and other lender charges. Lender B offers you a higher interest rate, 6.75%. At first glance, you'd throw this offer in the trash. It's 0.25% higher, but you look closer at their fees. They're only charging $2,000 total. So who's giving you the better deal? The sticker price shopper says lender A hands down. 6.5% beats 6.75% every single day. But the savvy homebuyer, the one who watches videos like this, looks at the APR. For lender A, when you take that extra $10,000 in fees and spread it across the 30-year loan, their APR, the true cost, jumps up to approximately 6.79%. For lender B, with their very low fees, their APR barely moves from their interest rate. It only goes up to about 6.81%. Wait a minute. My example broke. Let me readjust the numbers to make the point clearer, because this is critical. Let's try again. Lender A offers you that 6.5% interest rate, but with $12,000 in upfront fees and points. Lender B offers you a 6.75% interest rate, but with only $1,500 in fees. Now let's run the numbers again. Lender A, with that shiny 6.5% rate, has an APR that balloons to roughly 6.85% once those heavy fees are factored in. Lender B, with the less attractive 6.75% rate, has an APR of only about 6.8%. There it is. The loan with the higher interest rate is actually the cheaper loan over its lifetime. Lender A was dangling a shiny lure to get you hooked, planning to make their money back and then some through fees. Lender B was more transparent, offering a slightly higher rate, but a significantly cheaper overall package. Without understanding APR, 99 out of 100 people would have chosen lender A and ended up paying thousands of dollars more over the life of their loan, all while thinking they got the best deal. The APR is your X-ray vision. It allows you to see past the marketing and compare the true financial skeleton of each loan offer. So the rule of thumb is simple. When comparing loans, always use the APR as your primary guide for the long-term cost. But, and this is a pro-level tip that separates the informed from the expert, the APR isn't perfect. It has one major flaw in its logic. It assumes you will keep your loan for the full 30 years. And in today's world, almost nobody does. The average homeowner in the US moves or refinances every 7 to 10 years. Why does this matter? Remember, the APR works by spreading those upfront fees over 30 years. If you pay $12,000 in fees for lender A's loan to get that low 6.5% rate, but then you sell the house in year 5, you never get the benefit of the next 25 years of that lower rate. You paid a massive upfront cost for a long-term benefit you didn't stick around to receive. In that scenario, the loan with lower upfront fees, even with a slightly higher rate in APR, might have actually saved you money. So you have to ask yourself a critical question. How long do I realistically plan to stay in this home? If the answer is forever, or at least 15 to 20 years, then the APR is your North Star. Go with the lowest APR, period. But if you think there's a good chance you'll move or refinance within, say, 5 to 7 years, you need to do a little more math. You have to calculate your break-even point. You ask the lender, how many months will it take for the savings from my lower monthly payment to offset the higher closing costs I'm paying? If that break-even point is 4 years and you plan to stay for 10, paying the fees is a great deal. But if that break-even point is 8 years, and you think you might move in 6, you'd be making a huge financial mistake. Finally, you need to know what the APR doesn't include, because it's not a perfect out-the-door price. Certain third-party closing costs are typically excluded, like the appraisal fee, the title insurance, attorney fees, or homeowners insurance premiums. These can add up. So while the APR is your best tool for comparing two loan offers, the absolute final truth of your costs will be detailed on an official document called the loan estimate, which we will break down later. So when you ask your lender this question, you're not just asking for a definition. You are signaling that you are a sophisticated borrower. You're telling them you can't be fooled by a flashy low interest rate. You are focused on the total cost of borrowing, and you understand the nuanced relationship between upfront fees and long-term savings. This single piece of knowledge transforms you from a passive price taker into an active, empowered negotiator. You can now confidently compare offers and know with mathematical certainty which one is truly the best deal for you and your timeline. And understanding the role of those upfront fees, specifically discount points, is so crucial that it deserves its own deep dive. Are you paying points to genuinely save money? Or are you just giving the lender a big cash bonus on day one? The answer might shock you, and it's the entire focus of question number 5. So, what is this all-important question number 5? It's a question that sounds simple, but it peels back the first major layer of the mortgage onion, revealing a truth that can save you, or cost you, thousands of dollars on day one. The question is this: should I pay for discount points, and can you show me the exact, line-by-line, mathematical break-even point? Now, if the term discount points makes your eyes glaze over, stick with me, because this is where lenders make a fortune on uninformed buyers. Let's demystify this right now. Discount points are, quite simply, prepaid interest. You are giving the bank a chunk of cash up front at closing in exchange for a lower interest rate for the life of the loan. 1 point typically costs 1% of your total loan amount. So, on a $400,000 loan, one discount point would cost you an extra $4,000 in cash at the closing table. In return, the lender might drop your interest rate by, say, 0.25%, from 7% down to 6.75%. On the surface, it sounds like a decent deal. A lower rate forever? Sign me up. And this is the sales pitch. Your lender will show you the two options side by side. And the one with the lower monthly payment always looks more attractive. But what they're banking on, both literally and figuratively, is that you won't do the math. They are asking you to make a bet. A very expensive bet. You are betting that you will stay in that loan long enough for the monthly savings to add up and eventually surpass the thousands of dollars you paid up front. The lender, on the other hand, is betting you won't. They're betting you'll move, or that rates will drop and you'll refinance. If either of those things happens before you hit the break-even point, the lender wins your bet. They walk away with your $4,000, $5,000, or even $10,000, and you never see the full benefit. So, how do you calculate this break-even point and win the bet? It's shockingly simple, and it's a crime that it isn't automatically shown to every single homebuyer. Let's use a real-world example. Imagine you're getting a $500,000 mortgage. The lender presents you with two choices. Option A: a 7% interest rate with 0 points. Your monthly principal and interest payment is $3,327. Option B: you pay one discount point, which costs you $5,000 in cash at closing. In exchange, your rate drops to 6.75%. Your new monthly principal and interest payment is $3,243. Your monthly savings by paying for that point is $84. That's the difference between $3,327 and $3,243. Now, here is the $1 million, or at least $5,000 calculation. You take the upfront cost of the point, which was $5,000, and you divide it by your monthly savings, which is $84. 5,000 divided by 84 equals 59.5. That means it will take you 59.5 months to earn back the money you paid up front. That is just shy of 5 full years. This number, the break-even point, is your North Star. It transforms the decision from a vague feeling into a crystal-clear question of time. The only question you need to ask yourself is, am I absolutely positively certain that I will be in this house, and in this specific loan for more than 5 years? If you're buying your forever home, and you think rates are at a low point and unlikely to drop further, then paying points might be a fantastic financial move. After that 5-year mark, every single month is pure savings, pure profit in your pocket. Over 30 years, that $84 a month adds up to over $30,000 in savings. You paid $5,000 to make $30,000. Great deal. But what if you're in a job where you might get transferred in 3 or 4 years? What if you're a young couple who thinks you might outgrow this starter home when you have kids? What if the housing market changes, or interest rates plummet in 2 years and everyone is refinancing? If you sell or refinance at the 3-year mark, that's 36 months, you will have spent $5,000 to save only $3,024. You will have literally lit $2,000 on fire. You just gave the bank a massive interest-free loan that you never got paid back on. And they love it. This happens millions of times a year. This is why you must demand that your lender show you their math. Don't accept a vague, "Oh, you'll save money in the long run." Make them show you, on the official loan estimate document, the different rate options. Ask them, "Show me the option with 0 points. Now show me the option with 1 point. Now, calculate the break-even point in months for me." Get it in an email. Make them commit to the numbers. Because here's another little secret. The value of a point isn't fixed. Sometimes a lender will charge you 1 point to lower the rate by 0.25%. Other times it might only lower it by 0.1%. The value can change daily based on the bond market. You have to run the math every single time. Never assume. But we can take this to an even more advanced strategic level. Once you understand that points are just a negotiating tool, you can use them to your advantage, especially in a buyer's market. Let's say you do the math and realize that paying a point makes sense for you because you plan to stay in the home for 15 years. The break-even is 5 years, so it's a good bet. But you don't have an extra $5,000 in cash lying around after your down payment and closing costs. This is where you can use a powerful negotiation tactic. Ask for a seller concession to pay for your points. In your offer, you can ask the seller to contribute, say, $5,000 towards your closing costs. You then turn around and use that $5,000 from the seller to buy down your interest rate. The seller is happy because they've sold their house. You are ecstatic because you just got a permanently lower monthly payment for the next 30 years, essentially for free. You got all the upside of paying points without any of the upfront cost or risk. This is how you play the game at a professional level. You also have to consider the opportunity cost. What else could you do with that $5,000? Could you use it to buy new furniture? Make a small renovation that increases the home's value? Or what if you invested that $5,000 in a simple S&P 500 index fund? Historically, that money could double in 7 to 10 years. You have to weigh the guaranteed but slow return of paying points against other potential uses for that cash. So, the fifth question isn't just about understanding points. It's about forcing a conversation about time, risk, and strategy. It's about turning the tables and using the lender's own tools to your advantage. It's about making a conscious mathematical decision, not an emotional one based on which monthly payment looks smaller at first glance. By demanding the break-even calculation, you're telling your lender that you're not an amateur. You're a sophisticated buyer who understands the time value of money. You are not going to be the person who loses the bet. But here's the thing. Even if you masterfully navigate the discount points, getting the seller to pay for them and securing a fantastic interest rate, there is another, far more deceptive number lurking on your loan documents. It's a number that's legally required to be there, but is so widely misunderstood that it often does more harm than good. It's a single percentage that attempts to capture the true cost of your loan, but it can be easily manipulated by lenders to make a bad deal look like a good one. Getting this wrong can cause you to choose the wrong loan entirely, costing you tens of thousands. This number is the APR, and understanding what it truly tells you and what it hides is the entire focus of question number 6. So let's ask it. Question number 6, the one you need to have tattooed on your brain before you even look at a loan offer, is this. What is the true annual percentage rate, or APR, on this loan? And can you provide me a line-by-line breakdown of every single fee that's included in that number? Now I know what you're thinking. APR. It's that other, slightly higher percentage next to the interest rate. Most people think it's just a more complicated version of the interest rate, a kind of fine print number. And that's exactly what some lenders want you to think. But the APR isn't fine print. It's the headline. Or at least it's supposed to be. The entire concept of the APR was born out of a noble idea. Back in the day, comparing loans was a nightmare. One lender might offer a low interest rate, but slap you with a $5,000 loan processing fee. Another might have a slightly higher rate, but only a $1,000 origination fee. It was like trying to compare apples and, well, apples that cost a different amount depending on which grocery store aisle you were in. It was confusing on purpose. So, the government stepped in with the Truth in Lending Act and created the APR. The goal was simple: to create one single standardized number that represents the true cost of borrowing money over the life of the loan. It takes the interest rate and then bakes in many of the upfront lender fees, things like origination fees, processing fees, underwriting fees, and especially discount points, which we talked about earlier. By rolling those costs into the rate itself, it gives you a more holistic view. Think of it like this: the interest rate is the sticker price of the car. The APR is the out-the-door price. It includes the sticker price plus some of the dealer fees and prep charges, all expressed as a single percentage. In theory, this is fantastic. A loan with a 6.5% interest rate and a 6.7% APR is supposed to be a better deal than a loan with a 6.5% interest rate and a 7% APR. The lower APR should always win, right? Wrong. And this is the trap that snares millions of homebuyers. The APR has a fatal flaw, a secret assumption that can make the better loan on paper the far more expensive one in reality. To understand this, let's imagine two friends, Sarah and Mike. They're both buying identical houses for the same price. They go to two different lenders and get two different offers. Sarah's lender offers her a loan with a 6.5% interest rate. The lender fees total about $2,000. When you factor those fees in, her APR comes out to 6.61%. Not bad. Mike's lender, wanting to look more competitive, comes in with a super attractive offer. They tell him, "We can get you a 6.25% interest rate." Mike is ecstatic. But to get that lower rate, he has to pay a lot more in upfront fees. He's paying for discount points. His total lender fees are $10,000. When you bake those hefty fees into his loan, his APR comes out to 6.45%. So, who got the better deal? Sarah has an APR of 6.61%. Mike has an APR of 6.45%. On paper, every expert, every website, every calculator would tell you that Mike won. He got the better loan. But here's the secret. The APR calculation makes one giant, dangerous assumption. It assumes you will keep your mortgage for the full 30 years. It spreads the cost of those upfront fees, Mike's $10,000, over 360 monthly payments. But who actually keeps their mortgage for 30 years? Almost nobody. The national average is somewhere between 7 and 10 years before someone either sells their house or refinances the loan. So let's see what happens to Sarah and Mike after 7 years. For Sarah, her slightly higher interest rate means her monthly payment is about $75 more than Mike's. Over 7 years or 84 months, she has paid about $6,300 more in interest than Mike has. But remember those upfront fees? Sarah only paid $2,000. Mike paid a whopping $10,000. He started out $8,000 deeper in the hole than Sarah did. So after 7 years, Sarah has paid a total of $8,300 in interest and fees. That's the $6,300 in extra interest, plus her $2,000 in fees. Mike, on the other hand, has saved $6,300 on interest, but he paid $10,000 in fees. His total cost is still $10,000. After 7 years, Sarah is actually ahead by $1,700. And every single month from that point forward, her lead would have grown. If they both sold their houses at the 7-year mark, Sarah, the one with the worst APR, would walk away with more money in her pocket. Mike got played. He was so focused on the low interest rate and the better APR that he missed the forest for the trees. He paid a massive upfront fee for a long-term benefit he was never going to realize. This is why you cannot just look at the APR. You have to ask for the breakdown. When you see a low APR, you need to be a detective. Is that APR low because the lender has genuinely low fees? Or is it low because they're charging you an arm and a leg in discount points to artificially push the rate down, making the APR look good over a 30-year fantasy timeline? And it gets even murkier. While the APR formula is standardized, the fees that get included can be a bit of a gray area. The law says finance charges must be included. This covers things clearly paid to the lender, like origination, processing, and points. But it often excludes many third-party closing costs, like the appraisal fee, the credit report fee, title insurance, and attorney fees. So you could have two lenders with the exact same APR, but one of them has a relationship with a title company that charges $1,000 more than the other. That extra cost is completely invisible in the APR. It's a hidden landmine. This is why your question isn't just, what's the APR? It's the second part that holds all the power. And can you provide me a line-by-line breakdown of every single fee included in that calculation? This forces them to show their cards. You'll get a document called a loan estimate. On page 2 in section A, you will see that origination charges. This is your lender's bread and butter. This is where you see the points, the processing fees, the underwriting fees. This is the number you need to laser focus on. By comparing the interest rate, the APR, and the total origination charges side by side from different lenders, you can finally see the true picture. You can see if a low APR is a genuine bargain, or just a marketing gimmick that costs you thousands up front. You can decide for yourself if paying $10,000 like Mike to save $75 a month is actually worth it for your specific situation. Maybe you're in your forever home and plan to stay for 30 years. In that case, Mike's deal is a home run. But for the vast majority of Americans, it's a financial trap. The APR is a tool, a useful one, but it is not the oracle. It's a starting point for a conversation, not the final word. Understanding its hidden assumption, that 30-year timeline, is the key that unlocks your ability to make a truly smart decision. But even if you master the APR and get a loan with a great rate and low fees, there's another sneaky cost that can blindside you, adding hundreds of dollars to your monthly payment, often for years. It's a type of insurance that doesn't protect you or your house. It only protects the bank. And getting rid of it is a notoriously difficult process. This hidden monthly expense is called PMI, and understanding how to minimize or avoid it entirely is the subject of question number 7. So what exactly is this fee? It's called private mortgage insurance, or PMI. And question number 7 you absolutely must ask your lender is this: what are all of my options to reduce or eliminate private mortgage insurance, both at closing and in the future? Let's be crystal clear about what PMI is and what it isn't. Sounds like insurance, and it is, but it offers you, the homeowner, exactly zero protection. If you lose your job and can't make payments, PMI will not help you. If a tree falls on your roof, PMI will not pay for it. Private mortgage insurance is an insurance policy that you are forced to pay for, but the sole beneficiary is your lender. Protects them in case you default on the loan. Think of it as a penalty. It's a fee the bank charges you for being a higher-risk borrower. And in their world, the biggest sign of risk is not having a 20% down payment. If you put down less than 20% on a conventional loan, the lender will almost always slap PMI onto your monthly payment. It typically costs between 0.5% and 1.5% of the original loan amount per year. For a $400,000 loan, that's an extra $2,000 to $6,000 a year, or an extra $167 to $500 tacked onto your mortgage payment every single month. And here's the most frustrating part. That money vanishes into thin air. It doesn't pay down your principal. It doesn't reduce your interest. It builds you exactly zero equity in your home. It is, for all intents and purposes, like setting a pile of cash on fire in your driveway every month, just to make the bank feel a little cozier. This is why asking how to get rid of it is one of the most powerful money-saving questions in the entire home buying process. When you ask your lender, what are all my options? You're signaling that you're not a rookie. You're telling them you expect a full breakdown, not just the easiest answer for them. And their response will reveal one of 4 main strategies. The first, and most obvious, is to simply make a 20% down payment. If you can scrape together 20% of the purchase price, you sidestep PMI entirely. The lender's risk is lower, the math is simple, and you start with a healthy chunk of equity in your home. For many people, especially first-time buyers in expensive markets, this feels impossible. And that's okay. This is why the other strategies are so critically important. The second option is a brilliant piece of financial maneuvering called a piggyback loan. You might hear it referred to as an October 10th 80 loan. Sounds complex, but the concept is simple. Instead of one giant mortgage for 90% of the home's value, you get 2 separate loans. The first loan, your primary mortgage, is for exactly 80% of the home's value. Because this loan is at that magic 80% threshold, it doesn't require PMI. Then you put down 10% in cash. For the last 10%, you take out a second, smaller loan, often a home equity line of credit or HELOC. This second loan piggybacks on the first one, so you have 2 monthly payments instead of 1. But here's the genius of it. The combined payment of your 80% mortgage and your 10% HELOC is often less than the payment would be for a single 90% mortgage plus the costly PMI. Even better, the interest on both loans is typically tax deductible, whereas PMI is not. The downside? You have to qualify for 2 separate loans, which means a bit more paperwork, and the second loan often has a variable interest rate, meaning the payment could change over time. But if the numbers work, a piggyback loan can be a phenomenal way to kill PMI before it's even born. Now, this brings us to the third option, and this is a sneaky one. It's called lender-paid mortgage insurance, or LPMI. The name itself is a masterpiece of deceptive marketing. When your lender says, "Don't worry about PMI, we'll pay it for you," your alarm bells should start ringing. There is no free lunch in the world of finance. Here's how LPMI works. The lender does, in fact, pay the mortgage insurance premium in a lump sum up front. But to compensate themselves, they charge you a higher interest rate for the entire life of the loan. Let's run the numbers. Say you're getting a $400,000 loan. With traditional PMI, your rate might be 6.5%, and you'll pay an extra $250 a month in PMI. Your total payment is your mortgage plus that $250. With lender-paid PMI, the lender might offer you a rate of 6.875%. That $250 PMI payment disappears, hooray! But your mortgage payment itself is now permanently higher because of the higher interest rate. In the first few years, the LPMI option might actually have a slightly lower total monthly payment. This is the trap. Because while traditional PMI eventually goes away, that higher interest rate from LPMI is forever. It's baked into your loan for 30 years. Over the life of the loan, you could end up paying tens of thousands of dollars more in interest than you ever would have paid in PMI. The only time LPMI might make sense is if you know for a fact you'll be selling the house or refinancing in just a few short years, before the long-term cost of the higher rate catches up to you. Otherwise, lender paid is just a code word for borrower fleeced. This leads us to the fourth and final strategy, which deals with the second half of our question: getting rid of PMI in the future. Let's say you couldn't avoid it at closing. You are not stuck with it for 30 years. The law is on your side here. Thanks to the Homeowners Protection Act, lenders are required to automatically terminate your PMI once your loan-to-value ratio reaches 78%. This means when you have paid your mortgage down to 78% of the original purchase price. The key word there is original. Based on a standard amortization schedule, this can take a long time, often 9 to 11 years. But you don't have to wait that long. You can be proactive. The law also states that you can request in writing to have your PMI canceled once your loan balance hits 80% of the original purchase price. This can shave a year or two off the timeline. But here is the real secret weapon, the strategy that can save you the most money: getting rid of PMI based on your home's current value. Home values have been rising dramatically across the country. Let's say you bought your house 2 years ago for $500,000 with a 10% down payment, so you borrowed $450,000. Today, you've paid the loan down to maybe $440,000. But what if a new appraisal shows your house is now worth $600,000? Your loan of $440,000 is now only 73% of your home's new, higher value. You've blown past the 80% threshold needed to remove PMI, not because you paid down the loan, but because the market handed you a huge chunk of equity. You can contact your lender, state that you believe your home's value has increased, and formally request PMI removal. They will require you to have a good payment history, and you'll likely have to pay a few $100s for a new official appraisal to prove the value. But spending $500 on an appraisal to save $250 a month is one of the best returns on investment you will ever find. So when you ask your lender about your options for PMI, you're not just asking a question. You are opening a strategic discussion about down payments, piggyback loans, the true cost of LPMI, and a long-term plan for eliminating this parasitic fee. Getting this right can save you hundreds of dollars every month and tens of thousands over the life of your loan. But PMI is just one of the hidden costs. The real shock for most buyers comes at the closing table, in the form of a multi-page document filled with thousands of dollars in fees you've never even heard of. Uncovering these junk fees and understanding what you truly have to bring to the table is the goal of our eighth, and arguably most complex, question. So the question you must ask with a pen and notepad ready is this: can you provide a detailed, itemized breakdown of all closing costs on the official loan estimate? And can you tell me line by line which of these fees are set by the lender and which are negotiable? This isn't a casual question. This is you pulling back the curtain on the entire financial performance of getting a mortgage. Because the interest rate is the headline, but the closing costs are the fine print where fortunes are made and lost. Your lender will send you a standardized, 3-page document called a loan estimate. It's legally required, and at first glance it looks like a confusing jumble of boxes and numbers. But I want you to see this document for what it really is. It's the battleground. It's where you can save thousands of dollars with a little bit of knowledge and a lot of courage. Let's break it down. Think of it like an itemized receipt for the most expensive thing you'll ever buy. Page 2 is where the magic happens. you'll see a section called Closing Cost Details. This is your treasure map. It's broken into different sections, and we're going to focus on the first three because that's where the real game is played. Section A is Origination Charges. This is the lender's paycheck. It's what they charge you directly for the service of creating your loan. You'll see a percentage, often called points. 1 point is 1% of the loan amount. Sometimes you can pay points to lower your interest rate, but other times, lenders just charge points as a standard fee. Ask, is this point a fee for the loan? Or is it buying down my rate? The answer is critical. Right below that, you'll see the land of junk fees begin to sprout. Things like an application fee, an underwriting fee, or a processing fee. Now let's be real. Is underwriting and processing the loan not the fundamental job of the lender? Of course it is. Charging you a separate underwriting fee is like a restaurant charging you a cooking fee on top of the price of your steak. It's baked into the cost of doing business. These are often pure profit centers for the lender, and they are frequently negotiable. You can say, I'm comparing this with another lender who doesn't have a separate processing fee. Can you waive this to be more competitive? The worst they can say is no. The best is that you just saved yourself $500, maybe even $1,000. Next, you'll see Section B, Services you cannot shop for. This sounds intimidating, right? It's designed to. These are third-party services that the lender orders on your behalf. You can't choose the provider, but that doesn't mean you can't question the cost. The big one here is the appraisal fee. An appraiser has to come out and verify the home is worth what you're paying. The fee can be anywhere from $400 to over $1,000, depending on the property. You can't pick the appraiser, but you can ask your lender if the fee they're quoting is a direct pass-through cost or if they've marked it up. You'll also see things like a credit report fee. This is usually small, maybe $30 to $60. But I've seen lenders charge over $100 for it. The actual cost to pull your credit is minimal. Anything above that is padding. A flood certification fee is another one. It determines if your property is in a flood zone. Again, this is a third-party service, but you should ask if the price is fixed or just an estimate. These small fees in Section B add up, and while you can't shop for the service, you can absolutely call out what appears to be an inflated price. Now for the most important part of this entire exercise. Section C, Services you can shop for. This is where you take back control. This section includes some of the most expensive closing costs, and the lender is legally required to let you find your own providers for these services. They'll give you a list of their preferred or affiliated providers, but you are under zero obligation to use them. In fact, you should see that list as a starting point for your research, not the final word. The heavyweight champion of Section C is title insurance. This is a huge expense. There are two types: a lender's policy, which is required and protects the lender, and an owner's policy, which is optional but highly recommended, as it protects you. The fees for title services, settlement agents, and the insurance itself can run into the thousands. The price is often regulated by the state, but the service fees are not. By calling 3 different title companies, you could find one that charges hundreds of dollars less in settlement or closing fees than the one your lender recommended. You just saved the equivalent of a car payment by making a few phone calls. You might also see a pest inspection fee or a survey fee here. Don't just accept the number on the page. Go to Google. Search for pest inspectors near me. Get a few quotes. I can almost guarantee you'll find a better price than the default estimate your lender put on the form. The loan estimate is just that, an estimate. The numbers in Section C are your invitation to do better. Beyond these main sections, you'll see prepaids and escrow deposits. This is where you prepay for things like your homeowner's insurance for the first year and property taxes. This isn't a fee. It's you putting your own money into a special savings account, called an escrow account, that the lender will use to pay those bills for you. It's important to understand this isn't profit for the lender, but it is a massive chunk of cash you need to bring to closing. You need to ask your lender how they calculated this amount. How many months of taxes are they collecting up front? How many months of insurance? Different lenders might require a different sized cushion, which directly impacts your cash to close. So when you ask your lender to walk you through this document, you're listening for hesitation. You're looking for fees with vague names. Administration fee, document prep fee, courier fee. In today's digital world, what courier are they paying hundreds of dollars for? These are the junk fees. They are the weeds in the garden of your mortgage. Your job is to identify them, question them, and pull them out. Your strategy is simple. Get a loan estimate from at least 2, preferably 3 different lenders on the same day. Lay them side by side. Go through Section A on all of them. Lender A has a $900 underwriting fee. Lender B has a $500 processing fee. Lender C has neither. Why is that? Put them on the spot. Make them justify every single dollar they are charging you for the privilege of giving them your business for the next 30 years. This one question, this deep dive into the loan estimate, transforms you from a price taker into a savvy negotiator. It's the difference between blindly accepting a bill and demanding an itemized receipt and questioning every charge. This isn't about being difficult. It's about being diligent. You are protecting your financial future. The thousands of dollars you save here is real money that stays in your pocket for your down payment, for new furniture for your life. And once you've ironed out these costs, you'll feel confident that the number you see on closing day has no nasty surprises. But there's one more document, one final number that can change at the last minute and catch even the most prepared buyers off guard. Which brings us to the crucial 9th question. And that question is, what happens if the home appraisal comes in lower than my offer price? This isn't just a hypothetical scenario. This is the landmine that blows up more home purchase deals than any other, especially in a competitive market. It's the one variable that you, the seller, and even your lender have very little direct control over. It's the ultimate wild card. Let me tell you about a couple, we'll call them David and Emily. They have been saving for years. They did everything right. Got pre-approved, found a great real estate agent, and after losing out on 4 other houses in brutal bidding wars, they finally found it. The one. A charming 3-bedroom colonial with a big backyard for their golden retriever. The asking price was $475,000. Knowing the market, they offered $500,000 with a heartfelt letter to the sellers. And it worked. Their offer was accepted. They were over the moon, popping a bottle of champagne, calling their parents, picturing their future life in that house. They sailed through the initial underwriting process. Their financials were solid. Their loan officer was confident. They paid for the home inspection, which came back clean. Everything was lining up perfectly. They were about 3 weeks from closing when they got the call. It was their loan officer and his tone was different. The appraisal report had come in. The value? $460,000. $40,000 less than their offer. In an instant, the champagne-fueled excitement evaporated, replaced by a cold, sinking feeling of dread. You see, a bank will only lend you money based on the lower of 2 numbers: the agreed-upon purchase price or the official appraised value. In the lender's eyes, David and Emily weren't buying a $500,000 house anymore. They were buying a $460,000 house. This meant the bank would only finance based on that lower number, creating a $40,000 gap. David and Emily were faced with a nightmare scenario. Either come up with an extra $40,000 in cash on top of their already strained down payment and closing costs, or the deal was dead. And they didn't have it. Their dream was collapsing in real time. This is why you must ask your lender this question up front. You're not asking if it might happen. You're asking what is your specific process when it does. A great loan officer won't just say, well, you'll have to make up the difference. A great loan officer will be your strategist, your guide through this minefield. First, let's understand what your options actually are in this situation, because you do have them. Option 1 is to challenge the appraisal. This is officially called a reconsideration of value, or ROV. When your lender sends you the appraisal report, and they are legally required to give you a copy, you and your real estate agent need to scrutinize it like it's a legal document. Is the square footage wrong? Did the appraiser list it as a 3-bedroom when it's actually a 4-bedroom? Did they miss a recently renovated bathroom? These are factual errors that can be corrected. More importantly, look at the comps, or the comparable properties the appraiser used to determine the value. Were they truly comparable? Were they recent sales? Were they in the same neighborhood? Maybe the appraiser used a comp from a less desirable school district or one that backed up to a busy highway, while your dream home backs up to a quiet park. Your real estate agent's local market expertise is invaluable here. They can help you find 3 to 5 better, more relevant comps that support your purchase price. You then provide this evidence to your lender, who formally submits the ROV to the appraiser. Now be warned, getting an appraiser to change their value is difficult. They have to admit they made a mistake, which isn't common. But it is possible, and it's your first line of defense. This is where your lender's process matters. A proactive lender will guide you on exactly what kind of evidence is most effective. They'll know how to package the ROV for the best chance of success. A lazy lender will just forward your email and hope for the best. But let's say the challenge is denied. You move to option 2. Renegotiate with the seller. A low appraisal isn't just your problem. It's now the seller's problem too. That appraisal is now a material fact. The seller knows that any other buyer who needs a mortgage will likely run into the exact same issue with the exact same valuation. The house is now branded with that lower value. This gives you powerful leverage. You can go back to the seller and say, "Look, we love the house, but an independent bank-certified professional has determined it's worth $460,000, not $500,000. We need you to lower the price to the appraised value." Best case scenario? They agree. They're emotionally checked out, they want to move on, and they don't want to put the house back on the market and risk it all over again. A more common scenario is meeting in the middle. The seller agrees to drop the price by $20,000 if you, the buyer, can come up with the other $20,000. This often saves the deal. But what if the seller refuses to budge? This leads to option 3. You pay the difference. If you have the extra cash and you believe the home is worth it to you personally regardless of the official appraisal, you can bridge that gap yourself. This means you're knowingly paying more than the market value, which is a huge financial decision. You're starting your homeownership journey with negative equity. It's a tough pill to swallow, but in a market where you've lost multiple bids, sometimes it's the only way to secure the house you truly want. Finally, there's the nuclear option, walking away. This is where the single most important clause in your purchase contract comes into play: the appraisal contingency. An appraisal contingency is a clause that explicitly states that if the home does not appraise for at least the purchase price, you, the buyer, can back out of the contract without penalty and get your earnest money deposit back. It is your ultimate safety net. In hyper-competitive markets, some buyers are tempted to waive this contingency to make their offer more attractive to the seller. Do not do this unless you have a mountain of cash ready to cover any potential appraisal gap. Waiving this contingency is a massive gamble. If the appraisal comes in low and you can't cover the gap, you could be forced to forfeit your entire earnest money deposit, which could be tens of thousands of dollars. So when you ask your lender, what happens if the appraisal comes in low? You're listening for their entire playbook. Do they immediately talk about the reconsideration of value process? Do they have a dedicated team that handles these disputes? Do they offer to connect you with resources or advise you on negotiating with the seller? Do they proactively discuss the risks and benefits of ordering a second appraisal, which is sometimes an option, albeit a costly one? Their answer reveals their depth of experience. It shows you whether they see themselves as a transactional paper pusher or as your strategic partner. A good loan officer has been through this battle hundreds of times. They know the chess moves. They will calm you down, lay out your options clearly, and help you and your agent execute the best possible strategy. They'll turn a moment of pure panic, like the one David and Emily felt, into a manageable business problem with a set of possible solutions. You need an expert in your corner for the appraisal, because it's the one moment where your dream can turn into a financial nightmare with a single phone call. Ensuring your lender has a robust, supportive plan for that nightmare scenario is non-negotiable. You've navigated the pre-approval, the loan estimate, the closing disclosure, and now the potential crisis of a low appraisal. You've signed the mountain of paperwork, the keys are finally in your hand, and you walk through the front door of your new home. The journey is over, right? Wrong. In many ways, your relationship with the lender has just begun. And what happens after closing in the months and years that follow is something almost no one prepares for. It can impact your monthly budget, your personal data security, and your overall peace of mind for decades to come, which is why the 10th and final question is one that almost no one thinks to ask, but it's arguably the most important for your long-term financial health. And that question is, will you be servicing this loan for its entire term? Or is there a chance you will sell it? Now, on the surface, this might sound like a weird technical question. You might be thinking, who cares? As long as my interest rate is the same, what difference does it make who I send the check to? And the answer is, it can make all the difference in the world. This question pulls back the curtain on the entire mortgage industry and reveals a secret that trips up millions of homeowners. You see, most of us have this mental image of a bank, maybe like the one from It's a Wonderful Life. You walk in, you get a loan from a friendly banker named George Bailey, and for the next 30 years you make your payments to that same bank. But that is not how the modern mortgage world works. The company you're sitting across from, the one that pre-approved you, the one whose logo is on all the paperwork, they might just be the originator. Their primary business is to find customers like you, package up the loan, and then sell it on what's called the secondary mortgage market. Think of it like a car dealership. Their job is to sell you the car, not to be your mechanic for the next 30 years. When your loan is sold, one of two things can happen. First, the lender might sell the loan itself but retain the servicing rights. This is a pretty good scenario. It means that even though some other investor technically owns your debt, you still get to deal with the company you originally chose. You'll keep using their website, calling their customer service number, and your experience doesn't really change. But the second and far more common scenario is that they sell both the loan and the servicing rights. When this happens, you get a letter in the mail one day from a company you've never heard of, telling you that they now own your mortgage and you need to start sending your payments to them, effective immediately. This is where the problems begin. First, there's the sheer confusion and panic. You get a letter from XYZ Mega Mortgage Servicing, based in a state you've never been to. Is it a scam? Is it real? You have to verify it, change your automatic payments, and hope everything transfers smoothly. But the real issue is the quality of the company you're now forced to do business with. You spent weeks, maybe months, choosing your original lender. You read reviews, you liked your loan officer, you felt comfortable with their online platform. You made a choice, but you have absolutely zero say in who buys your loan. You could be sold to a massive, faceless corporation with notoriously awful customer service, a clunky, outdated website, and call centers where you're on hold for an hour just to ask a simple question. The relationship you carefully built is gone, replaced by a forced marriage to a company you would have never chosen in a million years. And this is where it can go from a simple annoyance to a full-blown financial nightmare, especially when it comes to your escrow account. Let me tell you a quick story about a couple named Mark and Sarah. They did everything right. They got a great rate, closed on their dream home, and made their payments on time. About a year in, they got that letter. Their loan was sold. The new servicer took over their escrow account, which, as you know, holds the money for their property taxes and homeowners insurance. The problem was the new servicer made a mistake. They miscalculated the property tax assessment for the upcoming year. They didn't collect enough money in the escrow account to cover the bill. So when the tax bill came due, there was a massive shortfall. We're talking thousands of dollars. Mark and Sarah got another letter. This one informed them that not only did they have to pay back the entire shortfall immediately, but their monthly mortgage payment was also going up by over $400 a month to prevent it from happening again. $400. That completely shattered their budget. They went from comfortable to house poor overnight, all because of a clerical error made by a company they never chose to work with. They spent the next 6 months fighting, making endless phone calls, and dealing with unimaginable stress to get it sorted out. This story is incredibly common. When a loan changes hands, the escrow account is the #1 point of failure. The transfer of data, the timing of tax payments, the change in insurance premiums. It's a delicate dance, and the new servicer often drops the ball, leaving you, the homeowner, to clean up the mess. So when you ask your lender, "Will you sell my loan?" you're not just asking a technical question. You're asking, is the relationship I'm building with you a 30-year commitment? Or is it a short-term fling? Can I count on your level of service for the life of my loan? Or am I going to be thrown into a lottery of servicers who may or may not have my best interests at heart? Now, what do you do with their answer? If they say, "No, we never sell our loans. We are a portfolio lender and service 100% of the loans we originate," you have found a unicorn. This is often the case with small, local credit unions or community banks. It is a massive green flag. It means stability. It means accountability. It means if you have a problem in year 15, you can walk into the same branch and talk to a real person who works for the same company. This is the gold standard. If they say, "We often sell the loan itself, but we always retain the servicing rights," that is the next best thing. It means your day-to-day experience won't change. You get the benefit of their potentially lower rates, which come from their ability to sell on the secondary market, but you keep the consistent customer service. This is a very good and acceptable answer. But if they say, "Yes, we almost always sell the loan and the servicing rights," which many large national lenders will, it is not a deal breaker. But it is a signal. It's a signal that you need to be prepared. It means you must be extra vigilant. When you get that transfer letter, you need to read every single line. You need to log into the new servicer's portal on day one and double-check that every number, your loan balance, your interest rate, and especially your escrow balance and disbursements, is 100% correct. You have to become your own advocate because the company you trusted is now out of the picture. By law, you have to be given notice. And there's a 60-day grace period after the transfer where, if you accidentally send your payment to the old lender, you can't be charged a late fee. But the responsibility ultimately falls on you to make sure the transition is seamless. Asking this final question transforms you. It elevates you from just another applicant to a sophisticated consumer who understands that a mortgage isn't a one-time transaction. It's a 30-year relationship, and you have every right to know who you'll be in that relationship with. Over the course of this series, we've armed you with 10 essential questions. From the nuances of your interest rate and APR, to the minefield of closing costs and junk fees. We've talked about rate locks, PMI, prepayment penalties, and the critical importance of understanding your closing disclosure. Each question was a tool to cut through the complexity, to challenge assumptions, and to demand clarity. This final question is the master key. It's about ensuring the stability and predictability of your financial life for decades to come. Because buying a house is the biggest financial decision most people will ever make. You're not just signing a stack of papers, you're signing up for a piece of the American dream. And you deserve to enter that dream with your eyes wide open, fully aware of every single aspect of the commitment you're making. Don't just take the first loan you're offered. Don't just sign where they tell you to sign. Ask these questions. Demand the answers. Be your own best advocate, because the person who cares most about your money is you. Use these tools to build not just a house, but a foundation of financial security that will last a lifetime.